Welcome everybody to our first Lunchtime Live, the first of many we hope. And I just want to personally say thank you very much for giving up some time on your lunch hour. I know how important time is. And I'll try and get this finished within 20 minutes or so, really. Plenty to learn, plenty to take away. Any questions, just drop them in the chat box and I'll answer them at the end. Okay, are we all ready? Let me see if we've got anybody in the chat. Can hear you loud and clear. Good man. Okay, so the first thing that we're going to learn on CVP analysis is something that you probably know already, but maybe not. And that's contribution. And contribution is basically your revenue, your sales, less your variable costs. Really important to understand that. And trust me, by the end of this, you will. Now, it's called contribution because it contributes to fixed assets. So what I mean is, if you see there, you've taken into account sales, you've taken into account variable costs. What you haven't taken into account is fixed costs. So if your contribution was 100, that's a contribution towards your fixed costs, agreed? Now, you would hopefully get more contribution than fixed costs and make a profit. But if your contribution exactly equals your fixed costs, hopefully you agree you would break even. Let me come out. Okay, hopefully that makes sense. Let's keep going then. So let's say that your contribution, which is your selling price per unit of 50, your variable cost per unit of 30, that will give you a contribution of 20 per unit. And if we sell 10 of those, then our contribution in total is 20 times 10, which is 200. And if fixed costs are 100, you've made a profit. Okay, so you've more than broken even. Let's have a go at the next one, where we don't sell 10, we sell 2. And if we sell 2, then 20 times 2, the profit is 40. The contribution is 40 towards fixed costs of 100, leaving us with, this time, a loss of 60. So when do we break even? Well, we didn't break even when we sold 2, when we more than broke even when we sold 10. So it's whether our contribution was underneath fixed costs or over fixed costs. You break even when you cover exactly fixed costs. So that's all you've got to remember. When you're looking for break even, you've got to cover the fixed costs. And when you're trying to work out how many units you need to sell, you think, right, well, how much contribution per unit, how many of them is in the fixed costs? So using that example, our fixed costs were 100, our contribution per unit, if you remember, was 20. So therefore, we should break even according to the formula at 5 units. Let's check if we did. So if we sell 5 and we're making contribution per unit of 20, then our contribution is 20 times 5, 100. And yes, because fixed costs are 100, we've broken even. So the next thing we've learned then, we learned that contribution was revenue less variable costs. And we now know that break even in units is fixed costs divided by, can you remember, the contribution per unit. Now, I want you to get this correct. These are fixed costs in total. You're covering your fixed costs in total, and you're working out your contribution per unit, so we can see how many units cover that fixed costs. Any questions, do pop them in the chat. Right. Now, if we covered fixed costs when we break even, if we cover more than fixed costs, we get a profit, don't we? So therefore, this should be quite straightforward. If we wanted to make, well, let's just remind ourselves, break even was covering the fixed costs, so fixed costs divided by contribution per unit. My question to you is, if I wanted to make a profit, what would I have to cover? Hopefully you agree both the fixed costs and whatever my target profit is. Divide that by contribution per unit, and that will tell you how many units I have to make and sell before to get to my target profit. So, target profit, fixed cost plus target profit divided by, hopefully you're shouting at the screen, contribution per unit. Here's a question then. Cowco has fixed costs of 50 but wants to make a 10,000 profit. You're thinking to yourself, yeah, but I need to know the contribution per unit. And it says, well, the variable cost is 10 and the selling price per unit is 20. So what's the contribution per unit? 10, isn't it? 20 minus 10. So the way we calculate this is we'd say, right, I've got to make 60,000. I'm having a contribution to that of 10. So 60,000 divided by 10. I need to sell 6,000 units to make that target profit. Okay, so what have we learnt? We've learnt contribution is revenue minus variable costs. We've learnt break even in units is covering your fixed costs. So fixed costs divided by contribution per unit. So remember, that's your fixed costs in total. And we've also just learnt that target profit in units is, can you remember? Fixed costs plus target profit divided by contribution per unit. Okay. How are you all doing, folks? While I take a little drink. Hopefully you're all happy and you're following along. Let's keep going. So, margin of safety. How safe am I? How far past the break even? This is really easy. All you need to do is work out what your budgeted sales units were. I budgeted to sell 100. I know my break even in units is whatever. So it's one minus the other. That's the safety. So if I budgeted to sell 100 and I worked out my break even units were 40 using what we did before, then my margin of safety is 60. Yeah, we can sell 60 units and still be safe. What I mean by being safe is we can still break even if we sold 60 less. So budgeted sales units minus break even units. Really straightforward. So what have we learnt? Target profit, fixed cost plus target profit divided by contribution per unit. And we now know that the margin of safety is you get your budgeted sales out and you compare it, you take away your break-even sales and you say, this is my margin of safety. I budgeted 100, I break even at 40. If I get my budget wrong by at least 60, I'm still okay. More than 60, I'm in trouble. Okay, keep going. What about margin of safety in revenue? I want you to always remember margin of safety is quite straightforward. So in revenue terms, it's just what was my budgeted sales revenue compared to what my break-even revenue is. I'll tell you how to work out break-even revenue in a few minutes. But obviously, if your budgeted sales revenue was 1,000 and your break-even revenue was 400, you've got 600 margin of safety, 600 less revenue you could make than you budgeted, and you'd still be safe. Okay. You're getting good at this now. Fixed cost plus target profit divided by contribution per unit, margin of safety, budgeted sales units minus break-even units, and finally, we just learnt margin of safety in revenue terms, budgeted revenue minus break-even revenue. But I've yet to tell you how to work out break-even revenue. So we know units is like that. Break-even revenue is going to be similar then. I've still got to cover my fixed costs, but instead of dividing it by contribution per unit, that's when I'm working out my break-even in units. This time I'm working out my break-even in revenue, so it's contribution to revenue, contribution to sales ratio. Sounds trickier than it is. The clue's in the question. you just take contribution and divide it by sales. That could be contribution per unit and sales per unit, or it could be contribution in total and sales in total. Okay, so I hope you're still all good with that. Let's keep going then. Here's a question. I'm going to do this question for both units and revenue. We've got fixed costs of 50,000. So my fixed cost would be 50,000. My contribution per unit, well, I sell it for 20. My variable cost is 10. My contribution per unit is 10 then. So my break even in units is 5,000 units. Now let's have a look over on the revenue side. Fixed costs are 50,000. My contribution to sales ratio. Contribution, 20 minus 10 is 10 to sales divided by 20. So 10 divided by 20 is 0.5. 50,000 divided by 0.5 is 100,000. That's what your break-even revenue is. You could have just done 5,000 units times by selling price of 20 as well, if you're clever. I'm going to take my picture off again because I think the internet is a bit dodgy in the little hotel I'm in at the moment, although I've stopped flashing, so that's maybe good. Okay, keep going. Hopefully you're all happy with this. What have we learned? We learned about contribution. Now seems easy, doesn't it? Revenue minus variable costs. We learned about break even in units. Now seems easy. Fixed costs divided by contribution per unit. Then we went to look at break even in revenue. Fixed costs still covering in total, but not divided by contribution per unit, but contribution divided by sales ratio. Okay. Then we learned the easy one, margin of safety in units, your budgeted sales in units compared to your break-even sales in units. Then we also learned margin of safety in dollars, which is your budgeted revenue in dollars, in any currency, compared to your break-even revenue. And we know how to calculate that. So you've learned quite a lot in, 10 minutes. Target profit, we also learned. Fixed cost plus target profit divided by contribution per unit. Okay. Even more we've learned. Target profit in revenue. Guess what this is then? So without even teaching you it, it's your fixed costs plus target profit, but I want that in revenue. So I don't divide it by contribution per unit. I divide it by the contribution to sales ratio per unit. Okay, could be per unit, could be in total actually as well. All right, so we had this margin of safety in units, 60 units. Now, what else is in your syllabus is working out margin of safety as a percentage. So you have to work out your margin of safety in units first. You take that 60 and you divide it by the budgeted sales per unit. So 60 divided by 100, put that in your calculator, and it's 60%. Simple as that. So calculate the margin of safety first, and then divide it by the original budget. Wow. So nearly there. Contribution, revenue minus variable costs. Break even in units, fixed cost divided by contribution per unit. Break even in revenue, can you remember? Fixed cost divided by contribution to sales ratio. Margin of safety in units, the easy one. Budgeted sales in units, take away break even in units. Next one we learned was margin of safety in dollars in revenue. So budgeted revenue compared to break even revenue. Target profit in units, fixed costs plus target profit divided by contribution per unit. Learned so much in just 10 minutes. Target profit in revenue, fixed costs plus target profit divided by, can you remember? Contribution to sales ratio. Margin of safety is a percentage, what we've just learned. You work out your margin of safety in units and you divide it by something. Can you remember what? It was the budgeted units, the original budgeted sales units, and show that as a percentage. Okay, nearly there, my friends. Now, that's all the numbers dealt with. There is in your syllabus as well multi-product, which is quite straightforward. You just do weighted averages, and maybe I'll do another lunchtime live on that for you. But we're looking at everything to do with single products here. And this is really important because you get asked about the words as well. So the words would say, look, what this is assuming is that all costs can be accurately classified into either fixed or variable. And sometimes you think of your telephone contract and things like that, it's not always possible. Another thing we need to be aware of is it presumes that total fixed costs remain constant. Well, they don't remain constant. The more volume you have, often the fixed costs go up, don't they? Variable cost, the total variable cost per unit remains constant, and often it doesn't because of technology and efficiencies. Some more assumptions then. Revenue behavior. We presume that the selling price remains constant regardless of sales volume. Obviously, the more you sell, often customers want a discount, so that's not necessarily going to be true. Activity levels. It presumes that volume is the only driver, that changes in cost and revenue are caused by the volume of activity. But what else you'd have going on is efficiencies and technology, etc. Another thing to be aware of is that we don't take into account any changes in inventory levels, so don't start talking about financial accounting, and that this analysis only applies within the range of when fixed and variable costs do actually stay the same. All of these things, by the way, don't just repeat in the exam, only just talk about it if it's in the scenario. So in the exam, you're going to get section A, OTQs. And how can this come up as an OTQ? 2-mark question, just might test the definition, the assumptions, the basic formulas that we've been through. Nice and straightforward. Now you'd be able to answer those multiple choice questions quite easily. Moving on then to section B. So these are where you get given a scenario and then you get 5 2-mark questions. And again, calculations or interpretations related to the scenario. So it comes up in section A and in section B. And finally, in the constructed response questions in section C, these are 20-mark questions. So there'll be more detail, but a mix of calculations, discussing the calculation. So when you discuss the calculation, think sales price, variable costs, fixed costs, how they could change, that sort of thing. And it'll be linked to something else, like what decision would you make? What's your margin of safety? How does that compare to budget? What's your margin of safety percentage? All those sorts of things that we've been through. So anyway, that's section C. Common errors in the exam, according to the examiner, using the wrong fixed cost. Remember, when you're doing the break even, you use total fixed cost, not fixed cost per unit, as many people often use. Failure to correctly handle semi-variable or stepped fixed costs. That's not, strictly speaking, part of this syllabus area, but comes up as part of that syllabus area. So make sure you can go and do semi-variable and step fixed costs. Again, we can do that as a lunchtime live maybe. And don't go applying irrelevant cost principles like things like inventory valuation, because there is no inventory assumed in CVP, as we've said. Some more errors. Providing calculations without saying whether it's relevant to the scenario, that won't get you marks. Generic textbook definitions, that won't get you marks. A misunderstanding of the underlying assumptions and their limitations. So again, these are all things that the examiner says people do wrong. So the words are as important as the numbers. And always conclude, look, you've done your CVP, you've done your margin of safety, you've done your break-even analysis. Come up with a conclusion. Moving on. Not showing workings clearly. It's great if you get the answer right, then you get full marks. But if you don't show your workings and you get the answer wrong, then you can't get like small marks for getting the calculations, part of the calculation right. So always show your workings clearly. And in the CBE, use spreadsheet formulas. Really helps, and the marker goes in and he marks that spreadsheet. So that's really useful. And then finally, some advice from myself, really. Read carefully, pay close attention to the question requirements. I know it's common advice, but make sure you do that. Show your workings, use the spreadsheet function, really helpful. Apply to the scenario, please don't use generic responses. Understand the assumptions. Don't go away from this thinking, oh great, I know all the formulas, and I kind of ignored the waffle he was talking about with the assumptions. And manage your time based on mark allocation and stick to that time. Okay, so all that's left for me is to thank you very much, and I'll look forward to seeing you again on accountancy.com.